Good morning, students. Welcome back. So today we are going to pick up new chapters and few auditing standards. So I'm just starting with the standards around this examination of prospective financial information. Okay, or maybe the controls at a service organization, or the one which is about the reporting on the compilation of pro forma financial information. Okay, so this is basically the chapter 11, right? So these are, you can say, some sort of different engagements wherein again some kind of examination is involved, or you can say some type of procedures are involved in respect of checking or in respect of verification. So we'll talk about this, all of these one by one, right? Okay, so let's begin our discussion with this standard about examination of prospective financial information. Okay, now, first of all, we should understand what is prospective financial information, right? Okay, so now, prospective financial information, we can say, is the financial information which is based on assumptions about the events that may occur in future and possible actions by an entity. Okay, now please understand that we are talking about financial information over here. Okay, so now financial information could be about the profitability, could be about the capex. Okay, so there are various aspects about which financial information could be available. Now, as regards the financial information, generally when you look at it, so there are a couple of things which are picked up for that. One is profitability. Okay, so that is generally a matter of a discussion or a requirement. And second is the cash flows. Okay, but over here, we are not talking about historical financial information. Okay, so we are talking about prospective financial information. Now, what do you mean by prospective? Prospective means something which you'll have in future. Okay, so now if you are talking about prospective financial information, something which is going to be there in future, so what does it mean? Means we are not having the numbers in place which are actual, right? So we are not talking about the actual numbers right now. Yes or no? Yeah. So in a way, we can say that the numbers or the information that we are talking about is something that we'll have to estimate, right? So now how do you estimate if, let's suppose, an entity has to think about its profitability, say for next 5 years? So what do? They will have to make some assumptions. Yeah. So they will have to plan what is it that the entity will do, maybe the new types of contracts they will have, maybe they will expand somewhere, maybe some type of customers they will target. Okay, some kind of cost reduction they may have, or maybe they have some plans to increase the cost. Okay, again, it may vary depending on the objectives, depending on the plan. But of course, one thing is for sure, that because we are not talking about historical information, so it's not going to be the actual one. So whatever is going to be actual is going to be different from what we are talking about right now. Okay, because to say that we will think of the numbers today for the next year, or maybe for the next 2 years, next 3 years, next 5 years, and those numbers are going to be exactly the same is not possible, right? And to think about all of those numbers in the future, what do you need? You need assumptions. So assumptions will become the basis for that financial information to be picked up. But who will do this entire exercise when you're talking about prospective financial information or the assumptions or thinking about these numbers which are going to be there in the future? It's the management. Okay. So it's the management which is going to do this, right? So it's not the job of the person, or you can say the practitioner, who's going to examine this. Yeah, but what is the underlying? Underlying is the prospective financial information, right? Now, what is a forecast? So, forecast again is what? It means the prospective financial information which is prepared on the basis of what? Assumptions and the actions the management is planning to take. Okay, now, what is the projection? Now, you can say these are again some types, or you can say some examples of the prospective financial information. So when you are talking about projections, here again, we are talking about prospective financial information. Okay. For which, what do you need? Hypothetical assumptions you will take about the future events, about the management actions. Okay. Right. Now, as regards this requirement of the examination. Now, whose responsibility will it be to prepare and present the prospective financial information? It has to be the management, right? So the management will remain responsible because management will prepare this, management will present this. So when it comes to the format or maybe some sort of criteria, the management will pick up. Okay. The basis they will pick up, the assumptions they will pick up. All of these things are going to be looked at by whom, are going to be prepared by whom? Of course, it's the management. Now, can the professional accountants be associated with prospective financial information? The answer is, of course, yes. Okay. Now, as regards this requirement of examination, now, of course, we are talking about a practitioner. Okay, so we are talking about a practitioner, you can say a chartered accountant in practice, who is going to come examine this information, okay, and who is going to provide an assurance on that. Means some sort of report he will provide on that. But in terms of executing that, okay, in terms of performance of procedures around it, now what is the most important part which is required to be reviewed? It's the assumptions. Yes or no? Why? Because if you look at the projections, let's suppose there's an Excel file which is produced to you. Now you are required to review that. Okay. Now, what will you review in that Excel file? There will be a lot of calculations, a lot of workings. You'll also try to do some sort of analytical procedures. Yeah, analysis, etc. You'll try to draw. But the most important part in those numbers, in that financial information, is going to be what? Assumptions. Yeah, because assumptions is the key. So that is the basis, right? That is the basis which has been used for the financial information which has been put in place. So if that assumption is changed, what will happen? The numbers will change, right? You tweak the assumptions, the numbers will change. So one part is to look at the assumptions. Means what are those assumptions? So let's suppose those assumptions have been looked at. Those have been verified that yes, of course, these are the assumptions, which the management can easily explain. Okay. But the next part will be to understand and to ensure that those assumptions are logical, those are reasonable. Okay, let's take an example to discuss this. Let's suppose management, let's suppose, has projected a revenue. Say, for example, say the revenue increases by 25% next year. Okay, so this is what the management has projected. Now, in this case, when the management will project this number, so there has to be some basis. Now, what is going to be that basis? Let's suppose management has explained, okay, various reasons as to why this number will be in place. Now, in this case, there are few things which the auditor needs to look at. How the revenue has increased, has behaved in the past few years. Okay, maybe in the last 3 years, in the last 4 years. What is the basis of the management considering that increase? So if let's suppose that is increase is in line with what the company has been achieving over the years. So it makes sense. Okay. But let's suppose that is not in line. Okay. But now why the management is thinking about it? Because let's suppose the management says that there was a plant which was in progress. Now that plant is all set up, infrastructure is all ready, so the production will take place, and that's why they will be able to generate that much additional revenue which was not there earlier. Okay, and there is again a logical basis attached to that, right? So these are some of the things which the auditor needs to look at. But the most important part is going to be what? Assumptions. Okay, so now whether those assumptions are reasonable, whether those are consistent with what has happened in the past few years. So it is not necessarily required that the numbers should always be consistent, but there has to be some linkage to that. Okay, or at least that linkage should be looked at. Okay, so even if let's suppose that is not in line with what has been happening in the past, which is okay, but again, as an auditor, you always go and check that. You look at the reasons for that. Okay, the basis of the assumptions, if let's suppose there are some underlying documents, if there are some contracts, if there are some arrangements basis which financial information has been provided, right? What has been the basis of presentation of that? Is there any such requirement? Okay, maybe of any specific party, or again depending on the requirement where it comes from. Okay, right? So some of these factors become important on the part of the management to look at. Now, as regards the assurance, now we are talking about an assurance engagement. Okay, now because we are talking about an assurance engagement, so that's why what do you need? You need some sort of formalities. Okay, because it's an assurance engagement, so that's why when it comes to the acceptance of the engagement, some of the things become important. For example, independence, for example, ethical requirements. Okay, and of course the engagement letter wherein you get on to the understanding about the terms, means who is going to be the recipient of this information. Okay, and intended use, for example, whether it will be available in general to all, or it will be a limited distribution. Okay, of course the assumptions, elements to be included, period covered, all of these things form part of what? Engagement letter, right? Now, as regards the examination procedures, I think we have already talked about it. But some of the things that we talked about will always require an understanding of the entity to begin with. And again, because we are talking about an engagement, so like any other engagement, what do you need here? Again, you will need a planning. Yeah, planning is a must. Okay, without the planning, you may not be able to again achieve the desired objective. So, planning is a must. So, planning is again what you will need here as well, right? Okay, now as regards the presentation and disclosure, now see it's again because we are talking about a prospective financial information, so one will have to understand the basis of this requirement. Okay, so where is this requirement coming from, and depending on the basis that we have, we need to ensure that the same basis has been picked up as regards the preparation as well as the presentation. Okay, means what are the accounting requirements which that specific requirement requires. Okay, so all of those factors management will have to consider, and of course the auditor will have to examine that. Now over here, what is going to be the report? So when you examine, let's suppose now you are not the auditor, you are actually an independent practitioner, right? Now when you examine that, so what do you do? So let's look at this report as well. So the title to begin with, addressee, of course, identification of the prospective financial information. So you'll talk about as to what is that information. Reference to the standards on auditing applicable to examination of prospective financial information. Then, of course, management's responsibility, right? Wherever it is applicable, a reference to the purpose or the restricted distribution of prospective financial information, right? Statement that examination procedures included examination on a test basis, because here again the similar type of procedures will be applied, which is what, test check in respect of different information which is available. Statement of negative assurance as to whether the assumptions provide a reasonable basis. Okay, opinion as to whether the prospective financial information is properly prepared on the basis of assumptions and presented in accordance with the relevant financial reporting framework. Appropriate caveats concerning the achievability of the results, because we are talking about the future. Okay, so it's as we discussed, it's not necessary that the information which is provided will always be the actual one. Okay, it may always differ from the actual one. Date of the report, of course, yeah. And then you have this date, place, signature, okay, to conclude this, right? Now, in this case, important part is what? I would say important part in this entire exercise will be the assumptions. Okay, because that becomes the basis, that becomes the core. So that's why in this entire exercise, the focus of the auditor, I'm using this term auditor, that is in the context of the person who will carry out this exercise. Okay, so the focus or this, you can say the entire focus should be centered around what? Assumptions. Okay, because that's the most important part, right? All right. So moving on to the next standard that talks about assurance reports on controls at a service organization. So now, as regards the service organization, we have had some discussion earlier as well. So would you like to touch upon that briefly? So I understand that Saminathan is also around. Can you just try to link this to another auditing standard. Okay, briefly we have talked about it earlier as well.
Sir, we have 402, sir.
Okay.
Yeah, using the service organization work,
Right.
using the of the service organization, wherein we
Okay.
talks about level 1 report, level 2 reports.
Okay.
Level 1 report is the description that management prepared and control editor to the on the particular date.
Right.
And for that, level 2 report is again the description and prepared and control implemented and designed and tested throughout the period.
Okay.
So these two type of report will be provided when the service organization used by that user entity.
Right.
Yes,
Now,
sir.
who is the user entity? If you can just elaborate on this, give some
Okay, sir.
more insights around this.
Oh,
So, who is
okay,
the
sir.
user entity? What has been done? What is required to be done? In what context you'll do this?
Okay, sir. Let me give the examples.
Right.
ABC Limited. Say
Okay.
ABC Limited has numerous activities of work. It decided to provide this service to perform by another entity. Say example
Okay.
XYZ.
Right.
XY, XYZ to the service organization
Right.
and ABC is the user entity. So
Right.
in the ABC entity, it has numerous activity. It provided the payroll services alone to the XYZ or any other activity as decided by ABC.
Right.
When the ABC Limited is giving to the XYZ, XYZ will perform that activity and provide the end result to ABC.
Okay.
So for that ABC auditor will be called as user entity auditor, and XYZ auditor when the audit is called service organization auditor.
Very good. Very good. So I think we have talked about it earlier. Okay.
Yes,
So
sir.
now when we talk about assurance report on controls at a service organization, so now we are talking about that service organization, which is required by whom? Auditor of the user entity. Okay. So earlier we were looking at it from the perspective of user entity, or you can say the auditor of user entity, right? So when we talked about it, and when we talked about it, we discussed that something will be provided by the service organization or the auditor of the service organization. Okay. So now the different perspective is what we are going to look at. So this standard deals with assurance engagements undertaken by a professional accountant in public practice to provide a report for use by user entity and their auditors. Why? Because there is a service entity which is providing some services, for example, payroll. Okay, so now this entity is managing this complete payroll on behalf of what? User entity. Okay, so for this entity, as regards that payroll, in terms of the controls which this entity will have, okay, now that is required to be looked at, that is required to be reviewed. Why? Because that is going to be relevant to the user entity's auditor. Because eventually, when it comes to the financial reporting of the user entity, okay, so now what is it that the auditor of user entity would want to look at? Controls, okay, to begin with. And some part of that user entity in a way is outsourced to this service entity. So if we say that the controls of the service entity as regards the payroll are good, So that will help the auditor of the user entity as well. Yes or no? So that's how it's going to help, right? So in a way, we can say it complements this auditing standard 402 in that reports prepared in accordance with the standard on this assurance engagement are capable of providing appropriate evidence under auditing standard 402, right? Now, this standard applies only when the service organization is responsible for or otherwise able to make an assertion about suitable design of controls. It does not deal with assurance engagements. Okay, so to report only on whether the controls at a service organization operated as described, or to report only on controls at a service organization other than those related to service that is likely to be relevant to user entities internal control. I think we have already looked at it. What is a service organization? We have looked at it. Now, why are the controls of the service organization important to the user's entity? That is again something we have looked at. That is a very, very important aspect. Now, who is the user auditor? Auditor of user entity. Who is the service auditor? Auditor of service entity, right? Now, in this case, objectives are very clear. Now we are talking about service auditor, means the auditor of service entity. We are not talking about auditor of user entity. Now, what are the objectives? Of course, to obtain reasonable assurance about what? About the service organization's description of its system, whether it fairly presents the system as designed and implemented throughout the specified period. The controls related to control objectives, which are stated in service organization's description of its systems, were suitably designed throughout the specified period, which is generally a financial year. Right? Were included in the scope of engagement, controls operated effectively to provide reasonable assurance that the control objectives stated in service organization's description of its systems were achieved throughout the period. Right? And of course, once the reasonable assurance is drawn, then of course to provide a report on that. Okay. Now, over here, we are talking about type 1 report and type 2 report. Again, similar to what we discussed earlier as well. Okay, in the previous session. Now, what is this type 1 report? So when we talk about type 1 report, so basically it's a report that comprises service organization's description of its system. A written assertion by the service organization that in all material respects and based on the suitable criteria, the description fairly presents service organization systems as designed and implemented at the specified date. Controls related to control objectives which are specified were suitably designed. Okay, were suitably designed. And now comes the difference between type 1 and type 3. Service auditor's assurance report that conveys reasonable assurance about matters referred to in point 2. But when it comes to type 2, now what will you have? Now, along with this point A as well as point B, what do you have?
Control effectiveness.
Yes. So if you look at this point C, the controls related to control objectives were operating effectively throughout the specified period, right? So you can say this is a better assurance as compared to what you have in type 1. Okay. Now, once again, because we are talking about an assurance engagement, so that's why what do you need? You will need all sort of those ethical requirements. Yes or no? And of course, independence you'll need, because it's a verification that you're going to do. So an engagement letter, okay, to understand what are the terms, what is the scope, some of these things to begin with. So all of these things have to be in place, okay, to have a clarity. And because again it's a project, again the nature of the project could be different. So that's why what do you need? You will need the planning. You'll need an understanding of this entity, because it's all about understanding of the controls, okay, because over here we are focusing on the controls, wherein the understanding of the process of the systems becomes all the more important, because we are not going to just go and test something, right? We are first of all going to look at the controls, okay. So till the time you don't obtain a thorough understanding as around all of those controls, you may not be able to again design the procedures which are required over here, right? Clear? Now, moving further, when it comes to the report, now what are those elements you'll have? Once again, the title, addressee. Now comes the different part. Identification of service organization's description of its system and service organization's assertion, which includes the matters for type 2 report or type 1 report. Those parts of service organization's description of its systems that are not covered by service auditor's opinion. If the description refers to the need for complementary user entity controls, a statement that the service auditor has not evaluated suitability of design or operating effectiveness of complementary user entity controls, and the control objectives, okay, if those are suitably designed or operating effectively, right? Then of course, depending on what we discussed in case of type 1, type 2, some sort of those things, whether those are in place or not, okay. So all sort of things you will include in the report which has to go out. Eventually this has to be again signed off with the date, place, some of those things you'll also have. Now when it comes to type 2, we have already talked about it, some of the additional matters you'll have, okay. So now what is it that you are going to have in type 2? So a separate section after the opinion that describes the test of controls that were performed and the results of those tests, okay. Now, in this case, service auditor will comment about the controls were tested, identify whether the items tested represent all or selection of items in the population, and indicate nature of tests in sufficient detail. Okay, if there are deviations, extent of testing that led to identification of deviations. Okay, all sort of things. If at all there is a modification, then that modification is also required to be captured over here. Okay, now moving on to the third type of engagement, which is about pro forma financial information. Okay, now this is a different thing. Now we are talking about reporting on compilation of pro forma financial information, which is included in a prospectus. Now, first of all, it becomes important to understand what is pro forma financial information. Yes or no? Yeah, because it appears to be slightly different, something new. Now, what is pro forma? So you can say, let's suppose entity is planning a different structure. Okay, currently they have a structure. Now they are planning to say restructure. So a new structure will be in place in future. So as of now, the structural changes are planned. Okay, those are not in place already. So it's a plan that this is how the structure of the entity will be. Now, with the new structure which is going to be in place, or you can say with a new type of event which is going to be in place, or maybe a new type of transaction which is going to be in place, which will happen in future, which has not happened today. What is the objective? Objective is to reconstruct the numbers, assuming that structure is in place today. Or you can say that with that new event in place or that transaction in place, how the numbers of the entity will look like. When we talk about the numbers, we are talking about the financial information. So the pro forma financial information refers to financial information shown together with adjustments to illustrate. Now, what is the objective? Now, this is the important part. To illustrate, objective is that you are trying to illustrate. For example, if you don't get any clarity, so what do you say? Can you give me an example? Because with the example, you will get clarity, okay, as around the concept. Now, the same thing is required over here. Now, in this case, what do you need? Because there will be a new event which has not taken place, that will be in future. A transaction that will be in future. Now, in respect of that, you are just trying to reconstruct the numbers. Of course, when that transaction will take place, the numbers will automatically change. But today, you are just trying to illustrate that if, let's suppose, this transaction gets executed, this is how the numbers are going to look like. Okay. So to illustrate the impact of an event or transaction on unadjusted financial information, as if, now this is the important part, as if the event had occurred or the transaction had been undertaken at an earlier date selected for the purposes of illustration. Right? Okay. Now, what do you mean by adjusted? Adjusted, you can say, is the current information. So that is unadjusted. That's why it's called as unadjusted. Okay. So you should not again get confused. What is unadjusted? Unadjusted means the current financial information. In the current financial information, if you bring in the adjustment of what? This new event or a new transaction. So what do you get? You get the pro forma. Or you can say the financial information that you get is what you call as pro forma financial information. Right? Now, the pro forma financial information is normally used in offer documents. So let's suppose a company is planning an IPO. Okay. So what do they have? So maybe they are thinking of some events or the transactions. So that's why, what do they want to do? They want to present their numbers. Okay, so that the users can get an understanding as to how the numbers are going to look like. Right? So that's where you commonly see this. Okay, and that's why we are talking about compilation of pro forma financial information included in a prospectus, because otherwise you don't find usage of this information. Okay, right? So it's normally used in the offer documents to demonstrate what effect of a transaction on the financial statements of a company, as if those transactions had occurred at an earlier date. Important part is what? That today When you say today means some cutoff date you'll pick up. The transaction is going to take place in future, but as of that cutoff date, so let's suppose the transaction is going to take place say in 2026, but let's suppose as of 2025, right? You'll want to present the numbers with the effect of that transaction. Understood? Yeah. So this is how you construct the numbers. So this pro forma financial information may take the form of statement of profit and loss and the balance sheet to illustrate how the transactions might have affected the assets, liabilities, and the earnings of the user. They also include notes in relation to the significant aspects of the transactions, assumptions used to prepare pro forma financial information, and the adjustments made. Okay. Now, what is the purpose? I think we have already talked about it. Now, over here, of course, because it's a compilation, so that's why what will you have? You will have different sort of requirements. Okay. First of all, you'll have the responsible party, which is what? Management. Gathering, classifying, summarizing, presenting financial information that illustrates the impact of significant event or transaction. Okay. Now, when it comes to the practitioner, okay, the one who is going to check this, here again, you'll have similar sort of procedures, those independence, ethical requirements, terms to be looked at as to what is required to be done, who is going to be the recipient. Okay, all sort of things are required to be considered over here as well. Right? Now, in this case, when it comes to the verification, so now this entire verification will be centered around what? That event or transaction. Yes or no? Because now, once again, we are not talking about the actual numbers. Correct? We are not talking about the actual numbers. We are talking about what? Assumed numbers in a way. So when we are talking about the assumed numbers, so we are just thinking that this is what is going to happen. Now, if let's suppose some financial information is available, so that is going to the base, that is going to be the basis to begin with, which will be used for constructing the, you can say, this pro forma financial information. So when it comes to the checking part, now what is it that the practitioner should be looking at? So let's try to look at it. Just give me a minute, I'll just share the file. Okay, so how do you actually go about it? So if we have to verify this, let's suppose, okay, so I'll just share this document. Now over here, we have the numbers to begin with. Okay, let's suppose currently there is some financial information. Yes or no? Because this financial information has to be in place. Correct? So this will become the basis to begin with. Now, in this financial information, what do? You will bring in the impact of transaction. So this impact of transaction is what you call as adjustment also, right? So this impact of transaction will give you the outcome in the form of pro forma. Okay, so this is what you are going to get. Now, in this case, One thing is to understand about this transaction. So when we perform procedure, what do? Of course, you'll want to understand and verify this. Means check in detail what is this transaction, what is going to happen, right? And how is this transaction going to impact that? Means this part. So let me just call it as say A, and let me just call it as B, right? So of course the working of this part B, how this entire part B will come out. Okay. But to begin with, for this part B to be put in place, what do you need? Part A. Yeah. Because there has to be some basis over which you will make the adjustments. So if you pick up that basis wrong, then of course this impact of the transaction on that basis will automatically go wrong, right? So that's why another type of procedure that you will apply will be on this. You can say the basis, or you can say this financial information which will be there to begin with. Okay, that will also play an important role, right? So this is how you will approach this. Okay, once you have this in place, of course, that is how you will achieve this. Yes or no? So that's how you will achieve this pro forma, right? Clear on this? Yeah. So any questions so far, Swaminathan? Any questions? Or maybe if you'd like to add something to this,
No, sir, very clear, sir.
great. All right. So now let's talk about the content. Okay. What is it that you'll have in the report? So title, addressee, introductory paragraph, wherein you'll talk about the pro forma, okay, the basis that you will have. Important part is to explain the transaction over here. So in the pro forma, that explanation will be available, but over here you'll just be talking about that pro forma, of course, right? Then of course the management responsibility. Then comes the responsibility of the auditor, which is the practitioner here. Okay, what is it that the practitioner has done? That is about expressing an opinion whether the pro forma financial information has been compiled in all material respects by the responsible party. Yes or no? On the basis of what? On the basis of applicable criteria. Correct. So that is something you will be looking at, right? Clear? Now, a statement that the engagement was performed in accordance with this standard about the assurance, right? And then, of course, some sort of requirements in relation to the signature, date, place, etc. These are all standard. Okay, so you'll also have it over here as well. Yeah, like it goes out for any other report. Okay, now what we will do is now we will move on to the questions. So let me just pick up these questions one by one. All right, so let's look at this. Okay, so let's look at this, right?
Yes, sir.
A company has approached CA Hemant for an assurance report in respect of prospective financial information. Okay, something that we talked about. So over here, the subject matter is what? Prospective financial information. On going through the project details, it is noticed that depreciation reflected on the proposed fixed assets to be acquired in the prospective financial information has been calculated in accordance with provisions of the income tax. Is that a problem? We don't know, because the basis, till the time we don't know, we are not sure of as to what is the basis. It appears to be wrong. No disclosure is made in this respect too. Now, in this case, the question is how the matter should be proceeded with. Okay, so what do you do? How do you look at it? Now, in this case, before we get on to this, before we start discussing this, see, what do you observe in some of the cases? At times, because there are different types of engagements that we are talking about, right? We have talked about audit engagements. This is of course not an audit. Then we have talked about, in fact, even if we talk about today's discussion, so far we have talked about prospective financial information, pro forma financial information. Yeah. Generally, what happens in the exam is there is some sort of confusion amongst these different types of engagements. Okay, so that's why what will you do? Because there's a confusion, so at times you may start using the term auditor in respect of the practitioner, or you may start using maybe the language which you'll have in respect of audit. Yeah. And that is where it may go wrong. Now, please remember that assurance is a wider term and audit is only a part. Or even if we don't understand this, at least one part should be clear, that assurance and audit is not one same thing. Okay, so two terms are of course different, right? So now, while drafting your answer, okay, so this entire challenge you are going to face in terms of what? See, you'll know the procedure, you'll understand how to deal with this situation. But at times, the way you put it across, okay, maybe by using the terms auditor, audit, etc., some of these things may not appear to be appropriate, right? So I would say that is where you need to be slightly careful in terms of how do you draft it, right? Now, before we get on to the solution, okay, sure. So let's pick it up. Okay, Saminathan, would you like to have a discussion on this?
Yes, sir.
Yes, please go ahead.
As per ESA, SAE 3400, the examination of the prospective financial information. The prospective financial information is about that projection or forecast. It's based on the assumptions.
Right.
The assumption should be based on the historical financial information, whatever it's used.
Okay.
That is how. If it is a forecast, then it will be the assumption. Then if it is a projection, it is a hypothetical assumptions what we think about it.
Right.
Here, it is a company.
Right.
Company is only approach that auditor.
Right.
In this situation, they are asking us to give the project details, and depreciation is proposed as fixed, and they worked on with the income tax as per the income tax.
Yes.
Here, since it is a company, it has to be followed as per the Companies Act depreciation schedule.
Okay.
It is not a special purpose thing. Since it is a company, it has to be prepared according to the Companies Act.
Right.
The accounting policy, whatever followed by the company, is not in order,
Right.
and he has to be recalculate according to the Companies Act depreciation schedule, and ask the management to update it. Otherwise, he can think about for the reporting aspect, a modified opinion as per SCA 505, 705,
Right.
which talks adverse opinion or qualified opinion as the case may be. Or if not suitable, definitely that practitioner can try to withdraw from the engagement.
Okay. All right. Good. So now, in this case, what is the information? It's the prospective financial information. Okay. So that's why, as around the prospective financial information, what do? Here again, if you pick up that formula A plus B, your A is what? Historical financial information. Yes or no? Because that will become the basis for you to think of the future, apply the assumptions on the historical information, and then construct the numbers for the future, which is about what? Prospective financial information. Correct. Now, for you to do that, what do you need? Historical financial information. And there has to be some consistency around it. Yes or no? Okay. Now, in case of a company, what will you have? Of course, you'll consider the Companies Act, and basis which you'll apply the accounting standards as management. Okay. So wherein for calculating the depreciation, what do? Useful lives will be considered, which has to be estimated by the management. So can you go by the depreciation rates which is there in case of income tax act? Answer is no. That's what you'll not do in relation to historical financial information. Right? So until unless it is specifically required for any purpose, you'll not do that. You'll not apply that. And if let's suppose you are thinking of some event or transaction which is hypothetical in nature, basis this, then it may not really be prospective. It may could be in the nature of you can say pro forma that we just talked about. Okay. So that's why to say that the depreciation which the management has considered will be as per income tax, that doesn't seem to be proper. Okay. So clearly that doesn't seem to be proper. In fact, if you look at the question, okay, so looking at the language of the question itself, it appears as if this is the problem, right? And in this case, the fact that the projection has not been prepared on a consistent basis with the historical financial statements using appropriate accounting principles needs to be stated. Further, when the presentation and disclosure are not adequate, what do? You'll think of the modification. Okay. Again, depending on the impact which is there. So it could be a qualification, it could be an adverse opinion, or maybe in some of the cases, if let's suppose the situations are such, so to consider the withdrawal from the engagement. Okay, yeah. Now let's look at the next one. Bansi Group is a leading institution running prestigious postgraduate courses in the field of management. Okay. Its financial statements are audited by independent auditors. So we are talking about audit of financial statements. Now, before the start of this academic session, board of this institution. Now, what is the role of the board? Board is like in a company, you have board of directors. So over here, if you talk about this institution, you have a board. So what is the role of the board? To manage the affairs, okay, to look into some of these things regarding accounting and all, including the audit. Okay, but largely it's about the affairs of the entity. That is what they take care. So that's the role of the board. Okay, similar to what you see in case of board of directors in case of a company. Okay, so the board had outsourced its entire process of inviting student applications. This has been outsourced. Right? Submission of applications, collection of application fees, including late fees, and such matters to Easy Solutions Limited. So there's an entity wherein they have outsourced this. Now, when it comes to the auditor of Bansi Group, right? For the financial statements audit, what do you have? Auditor of Bansi Group. Now, in this case, see, before we get on to the complete fact pattern, I would say a few things become important for us. Okay, let me just bring in on a single page for your clarity, right? So there are few parties that we have talked about so far. So there is one Bansi Group, which is an institute. You have one auditor of Bansi Group. Okay, so you have party number one, party number two. Then we talked about Easy Solutions Limited. So there is another party which is in place, party number three. Okay. Then, now these auditors of Bansi Group, so we are talking about two. Okay, so they want to be sure about design and operating effectiveness of controls at Easy Solutions Limited. What should be the nature of the report to be provided by auditors of Easy Solutions Limited? Now, in the fact pattern, this fourth party was not available, but now we also have in place one more party. What is that? Auditors of Easy Solutions Limited. Okay, so there are two auditors, huh? Auditor of Bansi Group, auditor of Easy Solutions. And there are two parties, or there you can say there are two entities, Bansi Group and Easy Solutions. Two auditors, two entities, right? Now, in the question, so you are also given this reference of the assurance engagement standard. Okay. But irrespective of whether that is given, not given, okay, I'll just mark this part. Now, what do you need? See, in this question, the important part is what? To have a clarity on the situation. Okay. Because till the time you will not have a clarity of the situation, what may happen is the nature of the report to be provided. You may just start explaining about any report. Yes or no? Yeah. So that's why I would say the most important part in this case is what? To understand this entire situation. Okay. Now, Saminathan, would you like to now discuss this? And while you discuss this, if you can also help us understand about each of these parties. Okay, in terms of the technical terminology, okay, as to what do you call these parties, each of them? What do you, any thoughts?
Yes, sir. Here the Bansi group is the user entity
Very
and the
good. Let me
independent,
just write down. So you
yeah,
are calling Bansi Group as the
user
user
entity.
entity. Okay,
And
very good.
independent auditor is here the user entity auditor.
Okay, so this is user entity auditor.
And EC Solution Limited is a service organization.
So this is service organization.
By the auditor means that service organization auditor,
Right. So let me just call it as service auditor. Okay.
service auditor, service entity auditor. Okay.
Right. And just for the purposes of referencing, I'm calling it as service auditor. Okay. Yes.
Yes, sir. Sir, sir, as per SCAE 3402,
Right.
assurance report on control of a service organization,
Right.
there are two report. It's talk about type 1 report and type 2 report. Type
Okay.
1
Sorry.
report.
Sorry to again interrupt you. Now,
Okay.
before we get on to the types of report,
Okay.
okay, something which has been asked for in the question.
Yes, sir.
Now, the question arises that there is an auditor of Bansi Group. Okay. Now, why is he interested in the reporting requirements or some of the controls of another entity? Because Bansi Group, of course, is linked to Easy Solutions, but as far as auditor or this user entity auditor is concerned, he doesn't have any engagement with Easy Solutions. So Easy Solution is not a client of user entity auditor. So why is user entity auditor focusing, or you can say requiring, anything around Easy Solutions? Means what is the purpose? What is the need? So why do you have this requirement in place? So what is the logic around it? If you can just discuss that part as well.
Okay, sir. See, actually, the Bansi group is the user entity. Here,
Okay.
that institution is outsourced the its entire process of investing, inviting student application, submission of application, and collection of application fees, and including late fee and such matter to EC Solution Limited. So
Right.
the activities it's outsourced to EC Solution Limited. Because of that, since the user entity is auditing the Bansi groups of institution,
Right.
so they want to get the reasonable assurance of
Okay.
that fancy group. So when the approaching that fancy group, he identified that some of the activity, this activities is outsourced to EC Solution Limited.
Okay.
So to get the confident, he is need. some sort of report from
Right.
the EC Solution Limited. So that is a reason that user entity auditor approach to Bansi Group. Bansi Group is informed that this activity is handled by so and so. I will get the report from them and I will give it to you. Like that, that conversation is already fixed.
Very good. Very good. Exactly. So that is where this requirement comes from.
Yes,
Right.
sir.
Yeah. So that's the context. Okay. Yes.
Yes.
Now, now let's come on to the requirement of the question. Okay.
Yes.
Yes.
The requirement of question: what should be the nature of the report to be provided by the auditor of EC solution, which means the service organization, to the user entity auditor. See,
Right.
in this case, they are checking that the Bansi Group auditor about the design and operating effectiveness of the control,
Right.
which means in the type 2 report only it talks about the operating effectiveness of the control.
Right.
So in this case it's clearly that user entity auditor is expecting to get the type 2 report from the service auditor.
Great. So now, when you talk about this assurance engagement, or when you talk about such type of requirement which the user entity auditor may have in respect of service organization. So what do you understand? Two types of reporting could be asked for, or you can say two types of reportings are in place. What are those? Type 1 and type 2. We have already talked about it. Okay. Now the question is what? Question simply wants an understanding about the type of report which is in place. Okay. So I would say this is a relatively easier requirement because over here you just need to identify the type. Okay. Yeah. Actually, you should have this complete clarity because in the question you may also be asked to sort of explain what this type 1 or maybe the type 2 is all about. Okay. Yeah. So in the given case, what do you have? You have this requirement coming from user entity auditor about the design and operating effectiveness of controls in respect of what easy solutions. Okay. So when you talk about design and operating effectiveness of controls, so this is what you get in case of type 2 report, not in case of type 1, because type 1 only talks about design. Type 2 talks about operating effectiveness. Yeah. So that's why, what do you call it as type 2 report? Okay. Moving further. So let's look at the next one. Management of S Limited requests you to accept an engagement to report on compilation of pro forma financial information to be included in the prospectus. So the management has reached out to a practitioner in the given case. Okay. Now, what is the request? So, why do they reach out? So, they reached out in respect of compilation of pro forma financial information. So, in the light of the auditing standard, sorry, in the light of this uh, standard on assurance engagement, you are required to comment what all factors this practitioner will consider, okay, regarding the company, okay, as regards acknowledging and understanding its responsibility in this matter before accepting the engagement. Means some of the acceptance and all formalities you are required to comment upon. Yes, over to you.
Yes, sir. Here you see 3420, the compilation of the proper financial information
Yes,
to be included in the prospectus.
right,
There are in the reporting format, it's talk about the management responsibilities and auditor responsibility like that. Here
right,
they are asking the management responsibility, what are the items to be included in it before accepting their engagement.
right,
So the management responsible on compilation of this, it's a purely on all the information, financial information, whether it is included or not, and adequately it's disclosed with all the material aspect in it,
correct,
and also the consistency, and also whether uh, any external party is used, the management expert is used in this case, and assumptions, accounting policies, estimates, and what are the unadjusted information, what are the adjusted information, all whether they included in it, and additional information, the responsible party whenever there is a need it, whether it everything is included or not, that that is a main responsibility of the management actually, total responsible. When we are compiling that information, they have to provide all the information in the compilation. That is
right,
their, that is the basic duty of the management. That has to
right,
be verified by the audit practitioner.
right.
Yes, sir.
Sure. So let's look at it. One, adequately disclosing and describing the applicable criteria. Applicable criteria means the basis which will be there for pro forma. Okay. Compiling the pro forma financial information on the basis of applicable criteria. Providing the practitioner with access to all information. Of course, that is required. Okay. Because if you were to examine, if you were to audit, how do you do that? Okay, you'll need records, documentation, material, all of these things you'll need. Additional information that the practitioner may request from the responsible party. Now, who's the responsible party? It's the management. Okay, so this terminology that we use, responsible parties, in the context of what entity, or you can say the management. Access to those within the entity and entity's advisors from whom the practitioner determines it necessary to obtain evidence relating to evaluating whether the performer has been compiled on the basis of applicable criteria. Means discussions with the required personnel of the entity. If let's suppose some third parties have been engaged, so the access to those third parties also, because the practitioner can go meet them, talk to them, discuss, okay, ask for some information. So all of these things the practitioner will require. When needed for the purposes of engagement, access to appropriate individuals within the acquiry in a business combination, right? So some of these things need to be in place, correct? All right. Now what we are going to do is we are going to look at this sort of case scenario. On the basis of this case scenario, what will you have? You will have some questions, right? Yeah, so let's look at this case scenario, and then on the basis of this case scenario, we'll discuss all of those questions one by one, right? Okay. So maybe what I can do is just give me a minute. I'll just try to open this document. Okay, no worries. So we can just look at it over here only. Yeah. Yes. So we are given draft text of report on examination of prospective financial information. So now please be clear that over here we are not sorry, over here we are not talking about all the assurance engagements that we have discussed. Okay, it's the report on examination. Just give me a minute. Okay, yeah, I'll have to just stop again. Just give me a minute. Okay, so seems all right. So let's look at this. So we are given a report on examination of prospective financial information of Top Edge Limited in relation to company's upcoming project prepared by a staff member in a CA firm unfamiliar with drafting such reports. So you can say the management has taken the assistance of a third party, okay, which is usually done. Okay, management will generally involve a third party for such type of exercises. But over here, the person who has done this, okay, who has prepared this, is not the one who is expert on this. So that's why they are saying prepared by a person who is unfamiliar with drafting such reports. Okay, sorry, it's about the reporting. So this reporting is what is done by the staff member from the CFO. It's not the management, sorry. The report has been drafted in a casual manner and may consist of omissions and errors. So now we are looking at the report. So to begin with, what do you have? Report on examination of prospective financial information to the board of directors, then the company. Then they are saying we have examined the projection of the upcoming project to come up at Ratnagiri of Top Edge Limited for the period from April 24 to March 30, as given in the prospective financial information from page 1 to 250, in accordance with Standard on Insurance Engagement 3400, examination of prospective financial information issued by the ICAI. The preparation and the presentation of the projection is the responsibility of the management and has been approved by the board of directors of the company. Okay. Our responsibility is to examine evidence supporting the assumptions, excluding the hypothetical assumptions and other information in the prospective financial information. Projection has been prepared using a set of assumptions that include hypothetical assumptions about future events and management's actions that are not necessarily expected to occur. we have carried out our examination of prospective financial information thoroughly. Further, in our opinion, the projection is properly prepared on the basis of assumptions as set out in Note 1 to 50 to the prospective financial information and on a consistent basis with the historical financial statements using appropriate accounting principles. Even if the events anticipated under the hypothetical assumptions described above occur, actual results are still likely to be different from the projection, since other anticipated events frequently do not occur as expected and the variation may be material. And then eventually it's signed off. Okay, so the name of the firm, okay, sign, designation, member number, membership number, some of these things are in place. Now, in this case, based on your knowledge and description of the case, okay, now in this case, the description of the matter is not separately given to you. That is given in the report itself. Yeah, so I would say that's one part for you to look at. Now, in this case, whose responsibility is to list out the assumptions in respect of that prospective financial information? One, it's the professional accountant issuing the report, auditor of the company issuing the report, management of the company, or the banker of the company. I think quite easy for you to answer. Yes, quickly.
Yes, sir. That the management of the company.
Very good. So when it comes to the financial information, right? So now in this case, one must understand the fact that this financial information, as regards its preparation, presentation, who is responsible for that? It is always management. So the practitioner is there to verify, examine, not to prepare. Correct? Yeah. And anyways, we are not talking about the auditor at all. Okay. So to say B and C are completely off. So even if there is a confusion, if let's suppose there is somebody who has a confusion, so the confusion should still be around A or C only. Though that is again not relevant, but I'm saying B and D are completely off. So what is the right answer? It has to be C. Next, which of the following statements is the most appropriate regarding use of prospective financial information to be included in such a report? Intended use of projection is required to be disclosed. It is further necessary to caution the users regarding inappropriateness of projections for other purposes. It is discretionary to state intended use of projection in such a report. See, intended use of projection is required to be disclosed. It is not necessary to caution the users regarding inappropriateness of projections for other purposes. D, it is the prerogative of the management to use a report in the manner it deems fit. Yes, over to you. Which of these options you think is the right one?
Sir, I feel that option B and D, it's straight away we can strike it off. But
Very good. And why so?
because it is discretionary to state that intended use of the projection in the it is a projection report. That
Right.
use will be specific actually.
Correct.
So that both that it is not the matter of management wish. That is the
Correct.
reason that D will, but it is a between A and C. That C, if you again if you look at it, is not necessary to caution the user because it is a specific purpose, which means the
Right.
perspective. But its most appropriate answer would be A only, sir.
Right. And why so? Because if you look at C, okay, A and C are moving in different directions.
Yes.
as regards this question. So A says it's necessary. C says no, it's not required. Yeah, but is that really required? Answer is yes, it's required. So that's why what is the right option? It has to be A. Okay. Now moving on to the third one. Which of the following statements is the most appropriate regarding examination of prospective financial information by a chartered accountant? I think it's quite generic. Accuracy of projections for is vouched for based upon performing procedures thoroughly. Projections can go haywire. It depends upon the professional judgment of chartered accountant to vouch for accuracy of projections. Accuracy of projections is not at all vouched for in an assurance report on prospective financial information. Matter of accuracy of projections or otherwise is not the domain of such an examination. Therefore, there is no reporting requirement under SA 3400. Right. So tell me, which of these options you think is the most appropriate?
Sir, I feel say option number C is straight away it's not suitable.
Okay.
This is we will eliminate the accuracy of the projection is not at all vouched.
Right.
See, here we are giving the assurance report. It has to
Right.
be vouched the assumptions and the projections. It's
Right.
very clear.
Right.
So that is ruled out. And
Right.
also option number D, the matter of accuracy of projection or otherwise is not domain of the examination. That is also incorrect.
Right.
When I'm between A and B, that
Right.
I feel A is more appropriate. That I can choose the option number A. The reason is that accuracy of the projection is vouched. When I am talking to that option number B, the projection can go haywire. It depends
Right.
upon the professional judge. It's not a professional judgment anyway.
Right. Right.
That we have to be. It has to be based on that sufficient and appropriate evidence.
Right.
He has to collect it.
Right.
The accuracy of the projection is vouched. This is a
Right.
correctly we can mark it out. Option number A.
Right. Sure. All right. So I would also go with what you just mentioned. Let's move on to the next one. Which of the following statements is the most appropriate regarding UDIN? Now the discussion is around the UDIN. In the context of examination of prospective financial information by a chartered accountant, it's mandatory to state, B, desirable to state, C, not required to state because it's not audit, D, it's not required to state as it's not an engagement related to historical financial information. So which of these options you think is the correct one? Yes, tell me.
I'm having bit confusion on this.
No
Actually,
worries.
the
See, the moment we say it's an assurance engagement, so what do you
assurance.
need? You need UDIN in place.
Yes.
Okay. So there is no desire that you'll have. The moment you say it's an assurance, so of course, UDIN will be required over there. Correct?
Yes, sir. Whether okay, whether it is a assurance or review, audit, all the engagement, it's needed the UDIN.
Yes. The moment you say it's an assurance engagement. Okay.
It is assurance
Now,
engagement. It's
yes,
needed actually.
correct. Yeah. So in such a case, UDIN will be required. Important thing for you to look at will be whether it's advisory in nature. Means it's other than assurance. If you say yes, then of course you will think about it. For insurance, you'll have this in place, right? Clear on this?
Yes, sir.
All right. So now, before we get on to a break, I think what I can also quickly pick up, maybe, yeah. So there are a few questions. Just give me a minute. Let me just pick up this RTP also. So now I have picked up this RTP. Okay, so we have one question around this prospective financial information. Okay, so this is January 26 RTP that we are looking at. Now, in this case, Moksha Limited has prepared prospective financial information for an upcoming expansion project. Okay, so now once again, we are talking about prospective financial information. On review, auditor finds that basis of certain assumptions is not disclosed. Highly uncertain assumptions lack sensitivity analysis, and date of preparation is also missing. Okay, so you can say there are three observations. Basis not disclosed, then the sensitivity analysis missing, and you of course have the date of preparation is missing. In addition, a recent change in accounting policy relating to revenue recognition has not been reflected. Okay, so this is the fourth observation one can say. In this context, what should the auditor consider while assessing the presentation and disclosure of prospective financial information and its underlying assumptions? Okay, yes, over to you.
Yes, sir. As per SCI 3400,
Right,
examination of the prospective financial information,
right,
the professional accountant has to has to check that accuracy and the assumptions is consistent with the financial historical financial information or not. That is a main duty, and whether it is properly disclosed or not.
right,
In this case, that it is not properly disclosed and revenue recognition is not also is based on the assumptions what they are mentioned is not clearly disclosed in this matter.
right,
So in this case, definitely the auditor can approach, discuss with the management
right.
to ask them to provide the assumptions as appropriately. Otherwise, they
Okay,
can go for reporting aspect, SCA 705 set
right.
matter. Yes, sir.
All right. So let's look at this. Now, what is it that, so if you look at those considerations, so now what are those considerations? One, whether the presentation of prospective financial information is informative and not misleading. Okay. Whether the accounting policies are clearly disclosed in the notes, whether the assumptions are adequately disclosed in the notes. It needs to be clear whether assumptions represent management's best estimates or are hypothetical. When the assumptions are made in areas that are material, subject to high degree of uncertainty, this uncertainty and the resulting sensitivity of results need to be adequately disclosed. Date. as of which the prospective financial information was prepared. Now, again, this is important. So, management needs to confirm that the assumptions are appropriate as of this date, even though underlying assumption information may have been accumulated over a period of time. The basis of establishing points in a range is clearly indicated, and the range is not selected in a biased or misleading manner when the results shown in the prospective financial information are expressed in terms of a range. If there is any change in accounting policy from that disclosed in most recent historical financial statements, whether the reason for change, effect of such change has been adequately disclosed, okay, which seems to have been happening in the given case also. Yes or no? Right? So these are some of the considerations you'll have. Now, let me just also look at one more document. Just give me a minute and then we'll take a break. Huh? All right, so we can take a break now, right? Yeah. All right, so Manish, we can take a break. Yeah. So let's break for 15 minutes and then we'll continue. All right. Okay, so now moving on to the next topic. I'll just share this document. Okay, so now we will talk about review. See, so far, in respect of various discussions we have had, we have used this term quite a lot. Review, audit, examination, verification. So no, yeah, so we have used this term quite a lot. But when it comes to review, you can say this term has a very specific meaning attached to it. And we can't really say that a review means it's a kind of audit procedure. No. In fact, what we can say is that when it comes to a review of financial information, so it's a kind of assurance that you provide when you review that financial information. Yeah, so it's a kind of assurance which is being discussed now. Okay, now what is the meaning of review and how is this different from audit? So that is again something we are going to discuss. So we have a couple of standards here. These are the standards on review engagement. Now, please remember that we are not calling them as auditing standards. Okay. Why? Because it's not an audit. So that's why, how do we call them as audit? Correct? So SRE 2400, this deals with engagements to review historical financial statements. SRE 2410, it's about the review of interim financial information performed by independent auditor. Now, let's pick up both these review standards one by one. But before we get on to the review, or sorry, in respect of these individual standard, it's important to understand the meaning of review first and how is it different from audit. See, when it comes to a review, so what do you have? Unlike audit, over here, the auditor or the practitioner will not provide reasonable assurance. So when you audit, what do you provide? Reasonable assurance, correct? But when you review as against audit, what do you provide? Limited assurance. Okay. Now, as the terminology only suggests, this assurance is limited. Okay. So you can say the assurance level is lower than what you'll have in case of reasonable assurance. So when you talk about audit, what do you write? It's a reasonable assurance. It's not absolute assurance. Yeah. So your level is lower than what absolute assurance will provide. And now you are going down further. You are reducing the level of assurance. And that's why you are calling it as a limited assurance. Okay. So limited assurance is the level of assurance obtained where the engagement risk is reduced to a level that is acceptable in the circumstances of the engagement, but where that risk is greater than for a reasonable assurance engagement. Number two, when it comes to an audit, auditor expresses an opinion, correct? But over here, when a review is performed, opinion is not given. So the auditor will provide conclusion. Okay, so it's a conclusion which is provided, and that's why it is also called as negative assurance. Okay, so we'll also look at the language which is used in a review report as against the audit report. So you'll also understand the meaning of what this negative assurance is. Right now, talking about SRE 2400, 2410. See over here, now we have come back to historical financial statements. So all this while when we were discussing about projection, pro forma, some of these things were not the historical financial information. Those were the numbers which will be there in the future. But now when it comes to a review, we are not talking about the future numbers. We are talking about something which is in place. So we are talking about actual numbers as per the books of accounts. Right. The only thing is that unlike audit, we are not performing uh, those level of procedures. We are performing limited procedures. Okay, let's suppose financial statements are there. So you're not auditing, you are reviewing. So you are performing limited set of procedures. Similarly, if you talk about interim financial information, what is interim? Let's suppose for a quarter, financial information is produced. Very commonly for a listed company, what do you have? Quarterly results. Every quarter, the results which the companies have to produce. Okay, be it P&L, be it the balance sheet numbers. So what is that? Again, interim financial information. Okay, now if in case that is required to be reviewed and not audited, so that is when we apply these standards. Okay, so now SRE 2400. So now we are talking about historical financial statements with which it deals. As we have discussed, objective is what? Objective is not to perform full-blown audit procedures, but limited procedures. That's why we are talking about review, and that's why we are talking about limited assurance. Now the question arises that when you are saying that limited assurance will be provided, procedures will be limited, what do you mean by that? Means what is the extent of testing? See, primarily when it comes to a review, so what do? It's largely driven through the inquiries and analytical procedures. So you can say a dominant part of the procedures of the practitioner or the auditor in case of a review will be what? Inquiries and analytical procedures. That doesn't mean that the practitioner will not go look into the details, will not at all get into the details of testing. Of course, he can do that wherever required, wherever he thinks appropriate. So nothing is going to stop him. Okay. If at all there's a need, underlying documents will be looked at. Some sort of testing of details will also be done. And at times, checking can also be extended, but that is not really required over here. So over here again, the objective is not to test the controls. Objective is not to get into the details or the testing of the details. Objective is to obtain an understanding, perform inquiries, more of inquiries, draw analysis. If there are variations, ask for them. If those are not in line with what it should be, ask for that. Of course, substantiate that through the underlying documents, but in a limited manner, not the one that you will do in case of audit. So that's how we'll say that the procedures are now limited as compared to what you do in case of audit. Right? Now, because it's an assurance, so that's why independence, ethical requirements. Do we need all of those things? Answer is yes. Engagement letter, acceptance procedures. Will that be any different from what you do in case of an audit? Answer is no. Planning and all, will that be required? Answer is again yes. Planning is the most essential part for any engagement. So when it comes to a review, will a planning be required? Answer is yes. There again, a planning will be required. Okay. Now, when it comes to an inquiry, so what do? You go discuss with the management, discuss with the concerned person, maybe the sales team, maybe the payroll team, maybe the finance team. Okay. Ask questions directed towards the objectives of the auditor. Okay, auditor, this term I'm using in the context of the professional who will be performing the review, right? And it's generally the auditor who does the review as well in most of the cases. Okay, if you look at the listed companies every quarter when they produce the results, so those are not audited, those are reviewed. Okay, that is where you have the application of this SRE 2410, right? Now, once you have the inquiries, and of course, in respect of the inquiries are also around the analysis that you draw. Okay, because that is what you want to understand, and that is where you also want to draw the logical conclusions. If those are in line with what should be in place, right? Yeah. And then, of course, some of the areas which you believe are important, wherein you like to substantiate that through the document, through the information. So the standard is not stopping the auditor from doing that. The idea is to give him the comfort in terms of what is required to be done, but in a limited manner. So over here, can we have the modifications? Answer is yes. Of course, the modifications are possible. The modifications may be required also, right? So all sort of reporting requirements do we have in this case? Answer is yes. Now, let's try to look at the report. Okay, so now in case of a review report, you can say it's similar to any other report. You'll have a title to begin with, addressee, then the introductory paragraph, which identifies the financial statements which are reviewed or the financial information which is being reviewed. Okay. Management responsibilities, of course, because again, the management is responsible for this. Okay, as to what is the basis, how that has been drawn. Description of the review of the financial statements and its limitations. Means it's a review engagement and it's a limited assurance engagement. The practitioner performs procedures primarily consisting of making inquiries of management, okay, and applying analytical procedures. And the procedures performed in a review are substantially less than those performed in an audit. And accordingly, practitioner doesn't express an audit opinion, right? Now, of course, then the conclusion is required to be given. Now, conclusion is in the form of a negative assurance. Okay, if at all there is any reporting requirement, that will also go out. Now, typically, what are the differences between audit and review? Though we have talked about it, but let's look at it again, because this, I would say, is an important part. And this is important for your understanding of review as well, because that's how you differentiate. So when it comes to an audit, it's about the reasonable assurance, which is a higher level of assurance as compared to review. In case of an audit, what do? You will perform elaborate, extensive procedures, including the test of control, substantive procedures, which you will not do in case of review. So review is largely about inquiries, analytical procedures. When it comes to an audit, so it draws reasonable conclusions on the basis of sufficient appropriate evidence. When it comes to a review, it draws limited conclusions on the basis of sufficient appropriate evidence. When it comes to an audit, it provides assurance opinion, okay, which is worded in a positive manner, unlike the wording of a review report, which is negatively worded. So that's why it's also called as negative assurance. We'll look at it. Okay. SRE 2410. Now, what are the differences between these two SREs, 2400, 2410? So you can say the underlying information. Over here, the information that we are talking about is the interim financial information. Now, what is interim financial information? For this interim financial information, we also have an accounting standard, correct? So this interim financial information is all about, one can say, the information which is produced for a period less than the financial year. In a very simple manner, that is what you can say. Okay, a period less than a financial year, correct? So that's what you call as interim financial information, which is not a complete set, or even if you prepare a complete set, that is for an interim period, but generally that's not a complete set. So now what we will do is, now we'll pick up some questions. Now, in respect of these questions that we pick up, just give me a minute. Okay. Okay, so we can pick up this case scenario first and then we'll move further, right? All right, so let's look at this. Okay. Below is given incomplete draft text of the review report on the review of financial results. Okay, so draft text of the review report is given. Basically, it's a review of financial results of Fast Operations Limited, but the draft text is incomplete, so that's specified. Okay, and this company is a listed company. Review is a compulsory requirement under SEBI of the case study. Which of the following engagement standards is most appropriate in relation to para 3? Means which standard you think is the relevant one? SA 810, SA 700, SRE 2400, SRE 2410. Yes, over to you.
Yes, sir. Yes, sir. Yes, sir. Straight away, yes, SRE 2410, sir. Indian financial statement.
Clear, yeah. And why it's clear? Because if you read this first, right? So if you read this second para, okay. So management is saying that they have prepared the financial information on the basis of Ind AS 34, which is about interim financial reporting. So that means it's the interim financial information. So therefore, can we apply SRE 2400? No, that is not possible. Can you apply auditing standard? No, because clearly in the discussion, what do you understand? It's a review which is going on. Okay. So SA 700, SA 810 clearly move out of the picture, right? So which is the only one left? And of course, which is the correct one? It has to be A. Next, which of the following statements is the most appropriate to be inserted in sentence beginning with a review is substantially XXXX in para 3. So you can just read this. I'll just give me a couple of minutes. I'll just be back. In the meantime, you can read this. Huh? Just give me a couple of minutes. All right. So if you look at this, now we are discussing about which of the following statements is most appropriate, right? Manish, I think I'll have to just break for 2 to 3 minutes, huh, please. Yeah, just give me a minute. Yes. Yeah, so just give me 2 to 3 minutes. I'll be back, huh? Right? All right. So now, which of the following statements in the given case that we refer to, yeah, is the most appropriate sentence? Means you need to sort of explain as to which one you will include here, right? A review is substantially broader in scope than an audit and consequently does not enable us to obtain assurance that we would become aware of all the significant matters that might be identified in a review. Accordingly, we do not express an audit opinion. Means the language you need to specify. B. Review is substantially broader in scope than an audit. I think this is very clearly you can sort of negate when you say A and B, to say a review is substantially broader in scope than an audit. Right? Let's look at B. Here again, it's beginning with the same sort of language. Now, C. Review is substantially narrower in scope than an audit. I think this still makes sense. Yeah. To say A, B, I think will be clearly out of the context. Right? So let's read C. A review is substantially narrower in scope than an audit and consequently does not enable us to obtain assurance that we would become aware of all the significant matters that might be identified in a review. Accordingly, we do not express an audit opinion. D. Review is substantially less in scope than an audit and consequently does not enable us to obtain assurance that we would become aware of all the significant matters. So effectively, if you look at C and D, the only difference is what? A single word. In C, it says narrower. In D, it says less, right? We have discussed that clearly A and B are incorrect. So which of these options you think will be the correct one?
Yes,
Yes,
sir. Yes, sir. See, as we discussed that the A and B is substantially broader than in scope than
broader.
audit. No, no, it is not.
Correct,
Actually, the review is lesser than the audit. Actually,
correct,
see, in between C and D, that narrower is where is appropriate, but here in this case, identified in a review
right,
might be here in the point number D, it's talk identified in an audit.
right,
So in this all the significant matter that might be identified in an audit is appropriate word over here.
correct. Very
So
good,
we will go with the option number D, sir.
very good. So its right option is option number D. Okay, now let's look at next one. Now, next one is in respect of para 4. So let's go back to para 4. So I think para 4 is about the last para. So based on our review conducted, so now what do you write? So it says choose the options. Okay. First, nothing has come to our attention that causes us to believe accompanying statement prepared in accordance with recognition and measurement principles and so has not disclosed the information required to be disclosed, including the manner it is to be disclosed or that it contains any material misstatement. B. Similar sort of language is there. Nothing has come to our attention that causes us to believe that the statement, okay, prepared in respect of some of these requirements has disclosed the information required to be disclosed, or that it does not contain any material misstatement. C. See, if you look at C and D, it says accompanying statement prepared in accordance with Ind AS, including the manner in which it is to be disclosed, right? Has disclosed the information required to be disclosed. If you look at C and D, they are worded in a positive manner. Actually, they are positively worded. If you look at A and B, the way the language is given, it's a negative language which they have used. They are saying nothing has come to our attention. Okay. So here again, because we are talking about a review, so we understand that it's a conclusion. Actually, that para is all about conclusion. Yes or no? So how do you word the conclusion? That is not positively worded. So with that understanding, option number C and D completely go off. Yeah. So I think somewhere we need to choose between A and B. So what do you think will be the right option amongst A and B? Yes, over to you. What do you
Yes,
think
sir.
will be?
Yes, sir.
Yes.
I feel A is more appropriate than B.
Okay.
The reason is that has not disclosed the information required to be disclosed in terms of 33B. That
Correct.
has not disclosed the word is mentioned over here.
Right.
And if you
As
look at the,
against
yeah,
has disclosed. Yeah.
disclosed. But yeah, this is a wording which we record. It has not disclosed, and in the bottom line, as you highlighted now, that it
Right.
contain any material misstatement. Here, the negative is in the bottom line,
Correct.
but it should be on the top line, not the bottom
Correct.
line.
Correct. Otherwise, that negative language is not appearing. Okay. So that
Yes,
language doesn't appear to be appropriate. So if you remove this word not, which has been done in B, okay, so the outcome goes wrong.
then it will give the positive meaning.
Correct. Okay, so that's why what should be the right option? Option number A. Okay, so then I think we are through with this. Yeah, so let's look at this one. So then I think we have this again RTP, right? So we can look at this one now. Amar Projects Private Limited, a company involved in turnkey infrastructure projects. Okay, so this is about turnkey infrastructure projects company is in discussions for a strategic joint venture with a foreign company. Okay, as part of the due diligence process, foreign entity has requested a review of Amar Project's interim financial statements for the 6-month period ended 30th September 24 instead of full audit. Okay, so it's a requirement coming from the investor, or you can say the prospective investor, for the review of interim financial information. That is for 6 months. To comply with this request, management appoints this CA Tanvi to conduct review and issue the report under SRE. Before accepting the engagement, CA Tanvi is evaluating scope of the review, nature of the assurance, appropriate format of a review report. Now, a couple of questions you are required to answer in this context. It's a review of 6 months financial information, right? What kind of assurance is given in a review engagement and how is it different from audit? What are the key elements that must be included in the written review report? What are the key elements that must be included in the written review report as per SRE 2410? Also explain whether a UDIN is required. Yeah, over to you. What do you think?
Yes, sir.
Yes, Saminathan.
It's a
Your thoughts?
yes, yes, sir. It is a SRE 2410 only. It's a
Okay,
review of interim financial statement. Yeah,
right,
the thing is that it's a 6 month period. It's
right,
not a complete set of things. So it is a
right,
interim only.
right,
How it is different from an audit. Audit is a full-fledged, wherein we will give the reasonable assurance.
correct,
Yeah, here we will not, we will give the conclusion only.
right. What else? See, I think in this case, what we should
Yes,
do is we should include that tabular information.
yes, sir.
Remember, we talked about difference between audit and review. So the question is clearly asking you to differentiate between that. So what do you say? At one place, you have reasonable assurance, wherein you provide opinion, okay, wherein the language is positively worded. Unlike the excuse me, one that you have, excuse me, okay, wherein you will provide a review, wherein your language is negatively worded, and wherein you will provide a conclusion. You will not provide an opinion. Okay, so that's one. Number two, now in this case, how should you provide the report? So, of course, various elements we just looked at. To begin with, you'll have title, addressee, then, of course, the interim financial information. Okay, that is the subject matter, whether that is complete set or interim. Management's responsibility, auditor's responsibility. Okay, statement that it's a review. Okay, and of course, the conclusion. And then you eventually sign it off. Right. Now, because it's a review, which is an assurance engagement, so will the UDIN be required? Answer is yes. Very clearly, yes. Okay. So UDIN has to be generated for sure. All right. Now, let's look at some more questions. Yes. So let's look at this. Roma Limited has entered into a contract with Dorma Limited. So it's about two companies. There is a condition in the contract by virtue of which Roma Limited is required to get its financial statements reviewed for a year on a quarterly basis in accordance with financial reporting provisions of the contract. Can Roma Limited get its financial statements reviewed from a professional accountant in practice? Over to you. What are your thoughts? What do you think? Can that be done?
Yes, sir.
So
The
it's not
room.
about should that be done. It's about can that be done? That is what you need to comment upon.
Yes, sir. The Roma Limited has entered into contract with the Dorma Limited. There is a contract condition of the contract, which means this is
Yes,
special purpose, special purpose. SA
right,
800, SA 800 will apply actually.
right.
Special purpose of a financial report, financial statement review.
Okay,
Here, since the quarterly information to be reviewed by the again that SA 2410 will applicable. It can be done by both, can be reviewed by that professional accountant in practice. But when he is reviewing that financial reporting, he has to in accordance with the SA 2410. When they are preparing, it will be as per SA 800.
All right. So let's look at this. See, the above financial statements are prepared in accordance with special purpose framework. Okay. But because it's a review, so that's why what do you apply? SRE, right? Next, you are conducting review of financial statements of a company. It is gathered upon inquiry that there is a possibility of material misstatements in the financial statements, okay, for which the review is being performed. So we are talking about this financial statement. There's a possibility of material misstatement. So how would you proceed in respect of this under SRE 2400? Over to you. What are your thoughts? What do you do when you have this situation? How do you deal with this?
Yes, sir. Definitely, he will do the additional procedure. He has to design and perform additional procedure to get into that material misstatement, if any, in the financial statement while he is review.
Okay.
And the while you're reviewing, he has to ensure that the whole financial statement, or it's not materially misstated. That part he has to review and conclude, sir.
So how will you do that?
He will do the inquiry, additional inquiry, the analytical procedure, and we will try to get sufficient appropriate evidence
Right.
from that wherever the area he is reviewing. He try to get that additional procedures here to perform analytical procedure or inquiry from that the person whoever is involved. He get the information.
Now, in the given case, if the practitioner becomes aware of matters that causes him to believe financial statements may be materially misstated, so what shall he do? Additional procedures, no doubt. Why? To reach a conclusion. Okay, yes or no? Now, additional procedures focus on that additional evidence he may require. It may be additional inquiry, analytical procedures, means the extent he can increase, or he can also eventually maybe resort to substantive testing wherever required. Yeah, because conclusion has to be drawn in a clear manner, right? Next, during the review of quarterly results of a company of which you are the auditor. So please remember, you are the auditor, but you are not auditing, you are reviewing the quarterly results. It's gathered on inquiries made that there has been a major fire in fabric processing plant of the company during the quarter. Okay. It has resulted in massive disruption in the operations of the company. Worse still, machinery and inventories of plant were uninsured due to carelessness of concerned staff, leading to substantial losses. Matter has been disclosed in interim financial information appropriately. Discuss how would you proceed or how would you deal with this as an auditor. Post your review means how do you conclude? So what do you do?
Yes, sir. This point is talk about that SCA 570 going concern.
Hmm.
Here, during his review, there is a fire,
Right.
and the management also is appropriately disclosed this information into the financial statement. That's correct. The going concern assumption they correctly captured and appropriate. In
Right.
that case, we will, the since it has been properly disclosed, we will give that emphasis matter paragraph and other matter paragraph as per SCA 706. We will as part of that auditor, they will give it is already disclosed and the fire happened so and so reason. Because
Right,
of this matter is not modified our opinion. That also he used to mention it. That is what it is needed.
right. Now, over here, because it's a review, so that's why what do you apply? 240. Yeah. So, as a result of inquiries or the other review procedures, a material uncertainty relating to an event or condition comes to auditor's attention. Okay. Which may cast significant doubt on entity's ability to continue as going concern. And the adequate disclosure is made. So, what will the auditor do? Emphasis of matter paragraph he'll include. He'll highlight that, right? Now, in the given case, what should he do? He should include that emphasis of matter paragraph. Next, CA Sirat is conducting review of quarterly financial information of a company of which she is also the auditor. She believes it's necessary to make material adjustment to quarterly financial information for it to be prepared in all material respects in accordance with applicable financial reporting framework. She has communicated the matter to the CFO and the audit committee. However, no response was received even after waiting for a reasonable time. What are the options you think are available to her? Over to you.
Yes, sir.
I think
Again,
it's
this.
quite straightforward.
Yes, sir. This is SRE 2410 again, that Indian financial statement,
Right,
that review of that independent auditor. Here, here the already the auditor is already that the independent auditor for statutory auditor and the interim auditor.
right,
First, he has to do the whether the report is can be modified,
right.
because they are not, management is not ready to amend these changes, waiting
Yes,
for reasonable time. They are not coming back. Definitely she can put for that modification in the report and
yes,
qualify it and try to withdraw from the engagement. Otherwise no, she can resign the existing engagement as well.
right. So now, what are the options you'll say are available in the given case? See very clearly. It says it's a material adjustment. What do you mean by material adjustment? It's a material misstatement actually. Yes or no? Yeah, because it's a material misstatement, so that's why it's required to be adjusted. Otherwise, will that be required or not? Answer is no. Otherwise, that will not be required. And that's why she has reached out to the concerned parties that please make the appropriate adjustment. So if they don't do this, the information is materially misstated. So if there is a material misstatement, what do? You will modify the report. In case of a review, do we have the modifications? Yes, in a similar manner, we have got all sort of modifications. It may be a qualification, it may be adverse. Okay. So that's one way of dealing with this. What is the other way of dealing with this? Withdrawal from the engagement, which is not the preferred one, of course. And possibility of resigning from the appointment to audit the annual financial statements. Okay, which is effectively the same thing, which is about withdrawal. So if she believes no, it's not going to work, so that's something she can look at it, right? So with this, we can just conclude our discussion. So thanks once again, everyone, for your time. Thanks so much. And we can just conclude this now, right? Manish, we can close this.
Thank you, sir. Have a great
Thank
day.
you. Right. Thanks. Same to you. Good day. Thanks, Manish. Bye.